Hello and welcome to the Next 100 Days podcast. My name is Graham Arrowsmith.
And my name's Kevin Appleby. So, Graham, we've got a great guest from the metropolitan area of New York City today, here to talk to us about passive income and real estate investing.
Just in case anybody's listening to this and they're getting mixed up with the Tony Soprano-like elocution of our guest, we've got Irwin Boris from the Heritage Group Capital business. Irwin, welcome to the Next 100 Days podcast.
Thank you for having me. Thank you. I'm honored.
Well, you're from the great state of New Jersey, aren't you? So it's it's much bigger than it kind of abuts New York, doesn't it? In the city. So is it Ridgewood that you're part of?
Correct.
That's if you like, that's a posh part, isn't it?
Well, it's a nice suburban, upper middle class area. It's close enough if you have to commute to Manhattan every day to New York City, but it's suburban enough where there's lots of wildlife. And if you go, 6 or 8 miles further north of where I live, you have bear and coyote and wild turkeys and lots of deer. If you want a 6-pointer, just look on my front lawn. It's venison. So.
That sounds like a fantastic place to live. Yeah.
Yeah, it is, except when you hit one and they jump out in front of you and you total your car. But
we've got similar problems around by us that we can frequently get deer running out of the forests around us onto the roads, and yet they do make a mess of your car when they hit you.
Well, earlier today, I've got to say, actually yesterday, I was in a yard with about 150 pregnant females. Of course, they're all sheep, and they were all ready to spew out their lambs, but they were doing it in order, sort of thing. So it was quite interesting to see. Oh, such lovely faces, actually, when you get up close. Really gentle, but very intelligent as well. They're cleverer than you would imagine. Anyway, enough. This could be the life, a story about wildlife, Kevin, but it's not.
Graham, it could, and
Irwin, I mean, Heritage is it's more than one thing. It's a family office, but it's also sort of an investment company. Give us an idea of this company that called Heritage. What is it all about?
Well, it started, 3 generations ago, where one of the patriarchs, who was a pharmacist, realized there was more money in owning the building where the pharmacy was than in operating and being a pharmacist. And so he, started, raising money from friends and family and others to buy his building, and then many others, because they realized they'd rather be property owners than be pharmacists or others. And at the height, there was probably 10, 11,000 apartments, most of them in the garden apartment style here in New Jersey. And then the second generation decided that the management business was a little too intensive, and they wanted to take a break. And it is when you have to deal with 10,000 or more tenants, and they're complaining, or you have to take legal action when they decide not to pay for whatever reason, and there's always something to fix.
We could just go back a step, would you mind? Because
Sure.
I'm pretty sure I heard you call them garden type.
I mean, they call garden style apartments, meaning it's a low rise. It's typically 2 or 3 story, or sometimes some of them were smaller, 4-story with an elevator. Older buildings, not like the high rises that we might be more familiar with in some metropolitan areas.
I see.
But more of an open style with lots of land around it. So we call them garden apartments.
Now, if you were in Glasgow, you'd call them tenements, wouldn't you? But at the end of the day, basically you might have 4 layers,
right?
And that's basically what you're selling. So a kind of a fairly low rise a city and so you would actually snaffle all these up, and you'd attract funds and manage the tenancy and stuff.
Yeah, back then it started with all family money, and then when the second generation decided that the management was very intensive, they wanted to take a step back. They sold those all, and they did a lot more net lease investment. You might have had 50 Pizza Huts or 75 Circle K gas stations, and things like that. And then, unfortunately, the patriarch at the time passed away when the principals were in their 20s, the two brothers, and they sort of got thrown into the business in a downturn of the economy, trying to figure out how to, create liquidity in a tough market. So they're really, they're really well schooled and hard the streets, so to speak.
Yeah.
And from there, when I met them 22 years ago, I was their banker. They came to me to finance an office tower in Newark, New Jersey, that they were buying that was largely empty, and they had a good business plan, and we lent them a very large percentage of the equity, and they paid me back in 18 months, and we did a few of those. And then over the years, I've acted, except for more recently, as sort of a part-time consultant when they needed me. And we scaled up to 9,000 apartments through the Southeast, through Virginia and North Carolina, South Carolina, back into the roots. So they said to me, "Look, we own all these office buildings. What do we do?" Especially one in Newark where we had Prudential Insurance as a major tenant. And I said, "You know what? You got 5 years left on the lease. We're not going to be able to refinance the loan, sell." And then the question was, what do we do? I said, we go back to where your grandfather and your father started. And we were very successful at buying apartments. Back then, people said to me, "Where's Raleigh, North Carolina? Where's Charlotte?" 7 or 8 years ago, it was like more tertiary, and people sort of ran away from it. But all along through the years, we've always been big investors in industrial, both the fancy stuff like Amazon occupies, as well as the smaller, what we call small bay or flex, where you might have 10 tenants in 100,000 feet. You might have, the plumber, the electrician, the painter, and all sorts of other trades.
In the UK, it's a bit like a business center, isn't it? There's almost like a conglomeration of
They call them business centers, and they typically have office space in the front and the delivery doors in the back.
Yeah.
And sometimes the tenant has half of their space is office. Sometimes it's a third of their space is office. Sure. We have some buildings where the tenants just like to be in a low-rise building and have their own front door, and it's almost all office. And that's why we call it flex, because it's flexible. It can be anything the tenant wants it to be.
Yeah. I'm amazed that your colleagues are not up again in front of a judge, really, because they borrow money off you and they pay it back. Yet somebody there might be a legal person in a court in New York who wants to pick holes in that. I mean, it's a current thing that's going on with Donald Trump, but it must be quite difficult.
Well, the problem is if you had a lot of office buildings, then the value is way down. Now, I've spoken with a few people I know for many years, the families that are big office owners in New York and other cities. And although some of them have been successful at continuing to lease to new tenants, the rents are down, the tenants are smaller. They're trying to keep their buildings full, for the cash flow, for the passive income, for the families, and also to keep the lenders current. Now, if you were, one of these syndicators doing apartments, a lot of them that are more active that you might see on social media trying to attract investors, most of them were in high school in the last downturn in 2008 to 2010. And, they don't understand what are the risks and how much leverage to take and why you might have a need to take a full-term interest rate cap protection, even though the bank isn't requiring it. They don't have enough, belts and suspenders on it. And that's why you see a lot of them in trouble. I get calls from investors, what do I do? They're asking us to, increase our capital contribution. Do I do it? Will I ever get any of my money back, or am I throwing good money after bad? And, I feel bad for some of these people because some of these syndicators should have known better.
Yeah.
We like to sleep at night. So we don't borrow more than 60 or 65% from the bank. We always take a full-term interest rate cap. We did a few deals 3 years ago down in Virginia, right around where the Navy, U.S. Navy has a lot of facilities, and some of them are our tenants, like General Dynamics, where they make torpedo tubes, and some of those other nice folks. And our partner said, the bank isn't requiring a 7-year interest rate cap. Why are you taking it? I said, it's cheap. I like to sleep. We don't know what's going to happen. Man makes plans and God laughs. So, so we took it. And now they're saying, oh, you guys are really smart. I'm like, no, I'd like to think that we're really lucky. And we make informed decisions based on what we've experienced in the past.
So let me just try and follow because
Sure.
You're a couple of chapters ahead of us.
I'm sorry.
You're only a chapter ahead of Kevin. He's
I don't know, Graham. I don't know.
Well, you guys got I guess what is it? The Pairs Group is pretty busy over there in real estate, aren't they?
The what group?
Pairs.
Pairs.
P-A-R-S?
I've got to say that it's not a name that rings a bell. And again, we have a Catholic understanding of a lot of things, and a very thin understanding at the best. But anyway, what I'm trying to I guess get at is that if you're only lending sort of 70% of a deal, give or take,
right,
then that means that the borrowers got to ante up money from either other lenders, and I don't know quite how that would actually. Can you have more than one lender?
You can. It's not really a lender. It would be somebody who might have a senior equity position.
Got you.
So we don't like that because in a down market, the preferred equity sort of cuts you both ways because A, you got to pay it, and B, it eats into the common equity.
Yeah.
So we typically put between us and our partners and our investors, we typically put 35, sometimes 40% of the equity in,
right?
Because it's important to have a sustained cash flow. It's all about the cash flow. We're not trying to hit grand slam home runs or score a goal every time we run down the field, depending what sport you're playing. And it's about getting the men on the base, whether it's cricket or baseball, just advancing them to score.
Yeah.
And as long as you can continually move the players, you'll score runs.
It's because, to your point, Irwin, you've kind of had this longer than recent downturn. We've all been through them. So
Correct.
Basically, you've got that perspective, but you've built it into your operating modality. So you do not overlend, if you like. You spend a lot of time looking at the value of the properties that you're going to go into, and you've got great expertise. All of those things come together within Heritage, but presumably within everybody else as well. Or is it just that some people are so fly that they don't give a damn?
Well, some of the, what you call syndicators, what you see on social media, they typically raise a fund where they have little, if any, of their own money at risk. And so it's all OPM, other people's money. And for them, they make their real money on the promote, on IRR or equity multiples, on realization of a profit. So leverage magnifies that, and that's why they look for structure where they can get the most at the lowest rate. And if you think of what happened, especially the last 2.5 years, it was almost like the perfect storm. Insurance on apartments in some markets tripled. It's, I have one legacy apartment building I'm an investor in, and insurance went from $300 per unit to $1,300 per unit, but we only had 50% financing, so we're okay. So so if your interest rate went up because your interest rate protection expired, you're a variable rate loan, LIBOR spiked, and your insurance tripled, and your payroll costs went up. That and the cost to renovate an apartment over the last 6 years has doubled. You're upside down.
Give me an idea as to why the insurers believe that they needed to triple your insurance. I mean, I've had a recent experience with these leeches when they've doubled the insurance rate on my Tesla. And there wasn't an explanation other than, well, we want more money from you. So basically,
based on how many losses they had in the previous year or two, and in here when the reinsurance market disappears, if they sort of like the first carrier sort of sells a piece off for a second loss position to like Lloyd's of London or something like that. So when the reinsurers disappear from the market, the primary cost of insurance spikes.
Right.
Now, if we look at all these these natural disasters we had between floods and storms here in the States. Uh, it's like in California, it had that monstrous snow in the mountains where people couldn't get out of their homes for a week. And now California's got like 3 years worth of rain in a week. And the storms from nor'easters and hurricanes.
Yeah, but they deserve it though, don't they? Let's face it, they deserve it, don't they?
Well, every once in a while, you got to spread it around, absolutely. But these insurers are greedy. It's one of those things that you got to have. You pray you never need it, and they don't like to pay out. So when they pay out, they want to make all that money back two or threefold.
Sure.
Yeah.
Actually, the California, we'd actually love the Californians. The truth is, not their politics, but we love them. And we've had plenty of Californians in our time on the show. But I'm impressed, Kevin, with the way in which this is it's not quite a pure play, but it is all about industrial properties, isn't it?
Correct. So over the years, we've especially when multi-apartment buildings, multifamily, got to be very expensive when you had to buy them on low cap rates, and everybody was working on a value add a business plan where you're going to put 10,000 into the apartment. We're going to move the rents $300 a month. It became a very finely choreographed ballet, where if your operating expenses went up, the deal didn't work. If your renovation costs went up, you had a problem. But as the market got hotter and the prices increased, people sort of skinnied up their assumptions. There was no margin for error. And since we were always in industrial, and there the tenants pay most of the operating, if not all of them on some of our properties, the operating expenses, we continued to focus on it. During COVID, everybody paid on time. Some people extended their leases. Some needed more space, depending what field they were in. And I like owning real estate where it's boring. It just pays. And I don't have to worry about insurance increases because the tenants share it. They pay for the management fee because we manage our own. They pay for all the overhead. They pay their own utilities. Where apartments, the landlord is absorbing a lot of these things. And when you look at what percentage of a tenant's income, they used to say 30% was maximum. Now people are paying 50% of their income for rent in some markets. It's just crazy. And the one thing I started to do was we still get all these emails from people looking for partners, is I go online and I like to see how many times the building has traded ownership in the last 12 or 14 years. And sometimes I have old offering memorandums, and everybody had a business plan. They're going to put so many dollars in and they're going to move the rents. I'm like, well, how many times can you put a new kitchen and bathroom in over 15 years and justify moving the rent $300? It became laughable.
Yeah.
But industrial, years ago, nobody wanted it. Now, because it's been performing so well, and you hear about Blackstone or Brookfield or all the big names buying it, we think a little smarter. We go to a lot of secondary markets where tenants need to be there, off of major highways. We have some really ugly buildings where the tenants have never moved and never can move, and because we're under the radar, and I don't need to,
What
do
what kind of, assuming that I had, part of my job is to attract high net worth individuals to various opportunities presented to me, and I help with that kind of activity. But this isn't about my business. Assuming that these people are interested in investing in you or with you, what kind of returns could they expect from this type of industrial building market?
Sure. I'll tell you. We look to buy them on higher cap rates. So we know there's a difference between the financing rate and the cap rate. So if I'm buying on an 8, I'm going to finance at a 6.25. So there's a delta there, and then with some leverage, you could probably get 7, sometimes 8% cash flow in the first year, if not definitely in the second year. Like I have one I'm playing with right now where the asset manager is overseas. It's their last asset in the Atlanta market, and I waited them out. They know I own, and I waited them out, and finally, broker was shopping it, and he says, look, you're the only one that really has continuous offer. Make them an offer. So I said, fine, here's my offer. It happens to be a 10% return without debt. I'll put a little debt on it because you still have closing costs. And I need money for leasing commissions and tenant improvements. But there, an investor can expect 10% in the first year before I increase rents over time.
Right. So,
And
is that a fair return on capital?
I think that's more than a fair return on capital. I don't look at IRR because it doesn't buy groceries. I can't eat it. IRR is a theoretical computation that if everything works as the business plan presented is going to work, that's what it is. Yeah. Sometimes it's better, sometimes it's worse. Yeah. But we know that it's we also have a different view. We look at when we buy an asset with our partners as if we have to own it forever. So can we keep it full? Can we generate income? If we hold an asset together, 5, 6, 10 years, and you have all your money back, and we can refinance it, do you care if you ever sell if you're still getting 9 or 10% a year and you have no equity? So that's how we look at it. It's all about being able to compound your income. And if you think about it, you can't eat the IRR. So if you invest for good cash flow that's sustainable, then the cash flow will pay for all the luxuries you want for yourself, while the appreciation and value will create generational wealth.
If you had to say, and let's say that Kevin's a policeman and you can't be untruthful here. Not that he is a policeman, he's an accountant, that's pretty much the same thing. But at the end of the day, if you had to sort of give all the things that could go wrong, and maybe have in part.
The building could be destroyed by a storm.
Right.
You could have.
It was left, but that's insured, though, isn't it? So
yes, it's insured, but you still might have. It takes a while to get the insurance money. The bank has first claim to pay off the loan. Sometimes we can restore the building and rebuild it. We have income coming in through the insurance or what they call rent loss coverage. Do that. You could have a very large tenant move out. Like we had a 2.5 million square foot portfolio that we had one tenant, Staples, the office supply people, were in 600,000 feet. And it took a long time to fill that space. And depending on the requirements of your lender, until you could fill that major, quote unquote, major tenant space, they could be holding all the cash flow. So I can't give anything to the investors. So we're very careful with large tenants or single tenant properties. We prefer multi-tenant properties because a multi-tenant industrial building is just like an apartment building. You lose 10 or 15 tenants, it doesn't make a difference. They're always going to move in and move out. Yeah. So a lot of it is choosing the right location to make sure that if one tenant moves out, there's another one waiting to move right in.
You're always going to be subject then to the state of the economy in this. That's
correct.
An economic downturn and a business like Staples finds themselves in a bad place, then it can come through with repercussions on you. Other ways that you can guard your business against a major tenant like that going bust?
Well, we that's why we don't do a lot of single tenants anymore. We did one back in June, and it's a tenant that employs 500 people in in 3 shifts. They work around the clock, and they're at a very low rent per square foot in a good location off of all the major highways. And I know, first of all, if they go bankrupt, first of all, they have a great financial statement, and they're in the pet supply business. And so then they distribute nationally. But because they employ 500 people, they can't move. They can't go to another city. They can't go to the other side of town, because if you're going to affect people's commute, they're going to get another job. They're not moving to commute another 20 or 30 miles. No. So we don't. But that's one reason we look at that. Also, it's about the people. It's about the sense of family. We talk to the facilities manager. I don't care what the rent comparable is or what the sale. I want to know if you can move. How sticky are you? But we, in general, we do very few single tenant buildings for just that reason. And we also look at what the lease expiration is. I don't want a major piece of my building expiring or renewing in any single year. No more than 20% a year is ideal. And so we purposely mix the lease terms, so different months and different years. So we have plenty of notice, and we've learned to have a year notice period that even if you have a renewal option and you don't let me know 9 to 12 months in advance, I'm showing the space to new tenants already. And when you see those new tenants walking with the broker, then the light bulb usually goes on and say, oh, are we staying or are we going?
Mm.
Yeah.
And does it take you 9 months
No.
to?
No, it should. That's why it's one of the reasons it's location that's important. What is the market? Are there barriers to entry? And that's one reason we also look at replacement cost. Because if you have to build a new building today, you have to charge top rent.
Hmm.
If you bought an older building, all right, your ceiling height might be a little lower. The column interior spacing is a little different, but I can afford to rent it at a lower rent. So even if I can't continually increase the rent, sometimes depending with what's going on in the economy, I can keep it full. That's how I look at it. Okay, worst case scenario, I say to the investors, look, we can't move the rents anymore. There's market, there's competition, it's the economy, but we're still going to be able to distribute 9% a year.
Mm.
You still get your tax benefits from depreciation, and you'll get 9%. And worst case scenario, assume all you got was 9% a year for 7 or 10 years, and you got your money back. We sold it for our purchase price. That's how I look at it. Would I own it in that basis? And if the Treasury is only paying me 4%, the bonds, and I can get 9 plus tax benefits, I'm doing okay.
Yeah.
Yeah. Yeah. And the model of investing in commercial as opposed to residential property certainly makes sense. And as it is in the US, I see the same situation in the UK, that if it's residential property, then the landlord takes all the responsibility for the maintenance. If it is commercial, then generally the business is taking the responsibility for everything. So there's no difference either side of the Atlantic. I guess one thing that is there a difference between the types of commercial space that we should be thinking about here? And we're seeing a lot of retail closing down because of the way the online marketplace is going. We're seeing a lot of office space being reduced because of hybrid work and remote work. Does that mean that the sort of thing that's more warehouse and manufacturing is the better sort of thing to be in?
I think so. We're having the same experience here in the States where retail, a lot of it is vacant. We have major shopping malls and plazas out of business. The anchors are closing, whether it's Lord & Taylor's, Macy's, they're all reducing some of their stores because the sales don't warrant them being open. Some of the neighborhood retail, the landlords are charging so much rent that if you're a store owner, you can't afford to operate anymore because so much of your sales goes to pay the rent. If you think of all these fancy designer labels, whether it's Gucci or Fendi or whatever, some of those flagship stores, the rent for that comes out of their advertising budget. They think they have to be there. So they find a way, even though the sales might not cover the operating expenses. So if I were going to invest in retail, it would be something that had a grocery store as my anchor, if a supermarket, because at least I know that people have to buy food, although some of it you can buy. Amazon here delivers groceries. And a lot of the other supermarkets now have online shopping where they either deliver to your home or you can drive up and they'll put the bags in your car. But the supermarket has a need to be there. And then some of the ancillary retail will fill in, whether it's some restaurants, whether it's a nail salon, a hair, when you get your hair cut. You can't do that online, although I don't have that problem.
No, mate. Kevin does.
Yeah. Maybe he wants to do it himself.
He takes it off every night and has somebody sell it.
That could work too. But you think about the neighborhood retail where they're essential. You got the drugstore, the card store, the dry cleaners, things like that, and they're all typically with a supermarket or food store.
Mm.
So some of the retail is suffering because of Amazon and others. Um, and office, we have some offices, even though businesses are trying to mandate into the office 4 days a week.
Mm.
I think the offices, because they have leases existing, but I think as those leases renew, a lot of them might say, hey, you know what? I don't need
Mm.
100,000 feet. I need 80,000 feet because people are only going to be here 3.5 days or 4 days, and some people can share a desk. Uh, and so now here in the States, they're talking about trying to take some of the older buildings and try to convert them into housing, into apartments. Now, sometimes
You
that
might well need them with all the extra people you're importing. But I mean, at the end of the day, does it matter to you that the property is going to be repurposed to house people, or does it matter to you as long as you get the return?
well, I don't think it matters as long as you get the return. Like if we look at Manhattan, especially down around Wall Street, years ago, down during the last downturn when people got laid off, they took a lot of those Class C office buildings and made them apartments, and now they're all full. So it's been successful. But
Yeah.
now with the price of some of the buildings, and you have to put additional costs in, sometimes they don't lay out properly. And everything, sometimes you have to cut through all the floors and put a new elevator in, so it's in the
Mm.
middle of the building, not in one corner to make it work. And I think over time, some of that will get done. Everyone's looking for a handout from the government to try to help that, facilitate that. I think the banks are going to take a beating when you have people like Brookfield and others just giving the keys back to the banks on their office buildings. Like I was in San Francisco several months back, and at night, all the buildings are dark
Mhm.
because people aren't there. Um,
There are there's a conversation going on in our country to do with no-go zones, but it seems that in America you've definitely got some. I mean, it was probably getting on 20 years ago that we were in San Francisco, and we were just a bit. Well, there's a route between where we are now and where we want to go to, and it goes right through Tenderloin. And the police people, the police at the time said, "Well, you don't want to be walking through there."
yeah, no, you still have areas like that where you don't
And
want it, so those buildings are abandoned. There's no one living, if there's people living there, they're doing so at their own risk, but
yeah,
they may not have a choice of where to live because of the cost.
yeah.
But there's always going to be areas that are not going to receive any economic investment because
Mm.
people don't think they will ever get a return.
Yeah. Is the generation that's running Heritage at the moment peaking in terms of age, and you're are you going to wind all this up, or is there a new generation? How are you going to manage
Unfortunately, no. The generation now, the principal that's running it is a few years younger than I am, and unfortunately, he has no children. So 10 years from now, it will either he'll hold it for cash flow, or they'll sell pieces off.
Mm.
Everything has a price, so although we assume, just like everybody else does, it's a 5-year hold, and here's what we're projecting returns at. They held one building for 47 years. One portfolio we put together, we held for 15 years. But it's all about cash flow, because a lot of times when you talk to your investors, and some of our partners are institutional, and
Mm.
they might have other problems in their portfolio, and they know they're getting at this point 12 or 13% return on their equity, and they're like, no, we like that return, let's just hold it. We don't have a loan maturity, we can
Mm.
afford to hold it, let's just hold it.
Mm. I mean, at some stage, somebody's going to come in and make you an offer, I guess, or make
Correct.
Heritage an offer. But the way I'm looking at your website here, and you've got four. I can just see on this particular page four different things that you set your philosophy around, and one is that our number one rule. And you said this right at the beginning when you said this. Our number one rule is don't lose money. Then you've talked about the power of compounding. Then you talked about we like or why we like industrial real estate, and we've talked a lot about that. And then you've talked about the concept of renting our money. Now, that last one is interesting.
Yeah, because basically you're renting your money, you're getting a return. And we say renting our money, was like we're renting our equity, is really what it is. And it all goes back to making sure that you're getting paid for your risk and getting a return on your equity.
Yeah.
I know Jeff Greenberg likes that. I'm renting my money. It's like I don't know where he ever got that from, but it is, people laugh. And it's we if it's not broken, we're not trying to fix it.
Yeah.
Which is why we take 60 or 65% from the banks. Everything else is equity from us and our partners. And our partners, I don't ever get a call from any of them. Because the money, when we do pay out, it's all electronic, goes right to their bank account. I might get a call once a year that says, hey, I'm going to be in town. Are you in your office? Or could I go look at the building? I'm, going to look at colleges with my daughter or my son, and we're going to drive by. Or the most frequent thing is, why does it take the accountant so long to prepare the papers? Because that I need for my personal taxes. That's the only thing I ever get from them.
So they're not that fussed about seeing the buildings. They just want the money.
No. Well, some of them do. Some of the larger partners, as a matter of course. So the institutional partners always come and look.
Sure.
Some of the larger partners do get a little more involved because they're sophisticated and they might own some real estate, a lot of real estate on their own. And we're happy to have another pair of eyes. I'm not perfect. I don't know everything. And sometimes, your background, even though it might not involve as much real estate as mine, but you might have another view that I might find interesting and might be able to use.
Do you take money from investors out with the United States?
Yes, we have had many investors from the Philippines, from China, from Hong Kong, from Germany, Italy. I actually have one who's now based in California, who's originally from the UK, who's working on some of our advertising. Who says, he keeps telling me, "Where's the next deal? I'm investing with you." But no, we have no problem taking money from anyone around the world. Our money is at risk along with everybody else's money, so we're not shielded. And because we don't like to lose money, that's the number one rule. Your money is just protected as our money is.
So what sort of minimum investment are you looking at when a partner's coming in?
Well, I understand that the first time, and that's one thing we're actually discussing, because we're actually going to go out and raise equity on more of what they call a retail level for high net worth investors this year. And so it's like, I'd like to have a minimum of $100,000, but I understand the first time an investor might not want to give me 100, he might want to give me 50, because he might want to put 50 in the next 6 deals. And it's okay. So that's probably where it'll be. It'll probably be 50. If it gets down to 25, we'll figure that out. You probably have a lot more people that'll give you 25 to try you out than 100 or 250. So it's about having the biggest pool of potential investors. And then I have to think that if you're in overseas there, I don't know what the tax treaty is. I don't know, so at what point does it make sense for you to invest? It may not make sense for you to have a small investment because of whatever legal issues and accounting rules you have. I know that I once worked with a family office there was a French family office that was domiciled in Luxembourg. And the principal lived in Switzerland for tax purposes. And when they would fund in equity, they would fund it in as debt, like a loan, because interest is treated differently than dividends,
right?
For tax purposes. I don't know how it is over there.
But that's why you have lawyers looking after family offices and
correct.
Yeah, I have to say, I think there would be a lot of interest notwithstanding the technicalities, but a lot of interest in investing in.
No, I'm happy to talk to anybody who's watching that. Hit the website up and.
But you're right about one thing there, and the conversations you've been having about the initial investment is something I'm involved in just about daily. That the conversation is always the same. That by all means, come in. You want them to spend 1 million with you. Truth is, they're not going to do that. I mean,
No, that not
they'll,
definitely not at the beginning. No,
it's a bit
I
like eating
agree.
an elephant, isn't it? And at the end of the day, they'll come in with more money, but once they've seen you throw them back some money after a little while, then they come in with a bigger.
Yeah, and what I've said to some people, like some people have, some investors have, they formed their own group, their own team. There might be 8 or 10 of them, and they like to form their own entity and come in together as one investor.
Yeah.
And we've sat with them. I said, look, if we have to come sit with you and you want to meet us face to face and see that we're real, we're happy to do that as well. Like I know we have a couple of investors that are in China on something we're actually going to sell now, and we said to them, they said, "What else do you have?" And we said, "We'll come talk to you. We'll come to you," because that's the way Asians work.
Yeah.
It's face to face. So we get on a plane and we go.
Yeah. No, well, I mean, you're very welcome in the United Kingdom. I mean, you run the risk of meeting Kevin Appleby in a dark place, but don't worry about that. I mean, he's usually very. What's that? What's that, Kevin?
Not that bad a risk.
It is a risk, really. But Irwin, you've been a fascinating guest on the Next 100 Days podcast. Thank you for joining us.
No, I'm happy to do this. At this point, I like to try to tell people the way I'm looking. I'm not out hustling for anybody's money on this show. I'm just telling you, here's how we look at an investment, and here's why we look at it that way. And I'm hoping that it helps somebody with their path towards creating a passive income stream and creating some wealth.
Yeah. And, we've covered a lot of different subjects over time. And we're after the same sort of thing. We're not sitting here trying to tell people, hey, go invest in this, go invest in that. We're trying to say that, if you are looking to do something in the next 100 days, well, here's what might be involved. Here are the sort of choices you might think about.
You're a very credible chap, actually, Erwin. You seem to be. I mean, you do look like a character from The Sopranos, but don't take that as a negative. I love the show. I really did.
No, I love the show too, because considering when I used to commute to Manhattan every day, I always used to drive by Bada Bing.
Yeah, so, it's a real place.
It's a real place.
All right, yeah,
it's right off the highway. But
yeah, wow.
For anyone really looking to invest, they should, if you look at what a lot of wealthy people say, they say poor people usually spend their money and invest what's left. Rich people invest their money and then spend what's left. And it really doesn't matter what the amount is. It's really in the philosophy that spend after you have invested, and that's how you create wealth.
Yeah. Well, on that point, we're gonna draw this to a close at this moment. But again, I'd like to thank you for being a guest on the Next 100 Days podcast.
So, Graham, last week we heard a lot about UK property investing and disrupting from Rob Moore. Today we've taken a look at what goes on in the USA. It's, I think, really interesting to draw the similarities and the differences, and to realize that investing in industrial property is completely different to investing in residential property, no matter where you are in the world.
Yeah, I think Heritage are producing good, stable, well-managed returns, and that attracts money.
Yeah,
it's they're de-risking. I mean, it's the sort of holy grail, really, of investing, because over their history they've moved from one type of investment to another, but where they are right now, it seems that they've really got a market that suits them. It doesn't come without challenges, but
hey, every market comes with challenges.
Well, because one of the things that we mentioned was this idea where Staples moved out, and they were a big entity in, if one company moves from an industrial unit, it might take you a while to get it re-rented, if you like, or re-let. And so that's why they like the idea of actually spreading their risk with multiple, shall we say, renters of properties and so forth. Clever stuff.
Indeed, clever stuff. But there we see one of the big things happening in the world, that we've got so much overcapacity in the retail world. Take
Mm,
Staples as an example. Why
mm.
does a business like Staples disappear from the high street? Well, it's quite simple. Because you can buy every single item that Staples sold on your laptop,
Mm.
and they're generally selling stuff you don't need to go and see physically before you decide whether you're going to buy it or not.
It's a shame 'cause I've got to say I used to like going to Staples,
Well, I did
uh,
as well.
and
No,
it
a
was
pack of
only
photocopy of papers, a pack of photocopy of paper.
oh I know, but it there was so many different reams there, and there was all different colours of pencils and goodness
Hey,
knows what.
don't get me wrong. I love buying stationery. It's one of
Yeah,
my
I mean, we
favorites.
can't be alone, Kevin. But a lot of people just loved going to Staples. But you are right. A few clicks of the button, and Jeff Bezos gets richer. At the end of the day, I think there's something that needs to be altered about that. Not particularly about him, but just the idea of the world operating on the internet. Because ultimately these things are stored somewhere and then delivered to you. But I for me, there's a benefit in shopping, even if it's at the industrial level. But anyway, that's that. We aren't talking about Staples per se, but Heritage Group Capital. If you're interested, then we'll put a link to the company on the show notes, and maybe you can, benefit from soprano-like investment returns that Irwin's offering people.
Absolutely. Yeah. So one for our American listeners today, Graham.
Oh yeah, probably, but also some from other parts of the world as well. Today, I've been Graham Arrowsmith.
I've been Kevin Appleby. Goodbye.
Goodbye.